Hi, this is PR Sundar. We have been receiving many requests to make videos about the stock market. Many people request basic videos, some people request advanced videos. So I'm going to make many videos and this is my first video. In this video, I'm trying to explain what is put option and what is call option in a practical way. Let us say market is trading, Nifty is trading around 12,300. There are people who believe that market will go above 12,500 and they will be buying the call option. If the market goes above, they will be making some profit and they are called option buyer, precisely call option buyer. And some people who think market will not go above 12,000 and they will be selling the 12,500 call option. They are known as option seller or option writer. Let me explain this with a practical example, an analogy. Let us say today there is a cricket match and Virat Kohli is coming to the ground for batting. There are people who believe that Virat Kohli will surely hit more than 100 runs. But there are people who believe that he will not hit more than 100 runs. Then there is a kind of betting happens. Normally, in other field, the betting is a binary event and the risk reward ratio will be 50-50. Let us say India and Pakistan playing a cricket match and one guy says India will win, other guy says Pakistan will win. So they bet 100 rupees. That means winner will gain 100 rupees, the loser will lose 100 rupees. Either you win 100 or you lose 100. So that is a 1:1 ratio or 50-50 chance. But in stock market game, it is not 1:1 or it is not 50-50. Here it works in a different way. So that is what I am trying to explain now. Let us say one guy says Virat Kohli will hit more than 100 runs and he will be prepared to pay 10 rupees. And the guy who says Virat Kohli will not hit more than 100 is a seller of an option. He will be receiving that 10 rupees from the buyer. Now there are two scenarios. One, Virat Kohli does not hit 100. So he is out before he reaches 100 runs. So in that case, the buyer who paid 10 rupees, he will lose his entire 10 rupees. The seller who receives 10 rupees, he will keep the entire money. So that is his profit. Second scenario, Virat Kohli hits more than 100. The rule of the game here is that the seller has to return 1 rupee for every 1 run hit by Virat Kohli beyond 100. Let us say Virat Kohli hits 200 runs. Then the seller will have to return 100 rupees to the buyer. The buyer paid only 10 rupees, but now he will receive 100 rupees. So which means he gains 10 times his investment. If Virat Kohli hits 300 rupees, then seller will have to return 200 rupees to the buyer. So here the risk and reward is not same as normal betting. Here the risk and reward will be totally different. Here the buyer, he pays 10 rupees to the seller. So the maximum money he can lose is only that 10 rupees. not more than that. But whereas the seller, he will have to return money to the buyer as per the number of runs hit by Virat Kohli beyond 100. There is a possibility Virat Kohli can even hit 500 runs. So the risk on the seller side is obviously more. So it is actually a kind of betting. Selling of a call option or buying of a call option is a kind of a betting. Here somebody saying market will not go above 12,500. Nifty will not go above 12,500. So that 12,500 is called strike price. In cricket, we say Virat Kohli will not hit more than 100 or Virat Kohli will hit more than 100. So then 100 is the strike price. Then the person who is betting that Virat Kohli will hit more than 100 is prepared to pay 10 rupees. So that 10 rupees is known as the premium money. So in call option also, somebody who says Nifty will not cross 12,500, he will be prepared to pay about 50 rupees. That 50 rupees is known as option premium. So there is a strike price, there is a premium. The third one, there is an expiry for this game. So Virat Kohli should hit more than 100 runs by the end of this game only. So it is a 2020 match which is going to finish in one day. So by the end of the day he has to do, and that is called expiry. The same way in Nifty should not go above 12,500 or will go above 12,500. So this betting also has a time expiry. So it should happen the end of this month. Normally the expiry is last Thursday of every month. So this time last Thursday of the month is January 30. So any betting happens, the result will be declared and settled by the end of January, that is 30th January, last Thursday of the month. So with this example of cricket, I am sure you can understand the buying and selling of call options in a better way. So buying and selling of call option is a simple betting where the buyer feels Nifty will go beyond 12,500. He wanted to make some profit, so he is buying the option. The seller feels that Nifty will not go above 12,500 and he is selling the call option. So as long as the market is not going above 12,500, the seller makes the profit. If it goes above 12,500, the buyer will make some money. Let me give another real life example to understand this. One day, one of my friends came to me and he told me his son is fresh from the college. He wanted to set up a business. So he was worried whether the business will be successful or not. So he was afraid of investing money. Then after listening to what his son is going to do, after analyzing everything, I found that this business is going to do extremely well. So I told my friend, okay, I will give you 1 lakh rupees free for you. I'm giving you 1 lakh rupees free for you. But one condition, if your son's business is not good, you don't have to return that money to me. If your son's business is making more than 10 lakh rupees profit in one financial year, whatever money beyond 10 lakh rupees he is making, you have to pass it on to me. So in this case, I am an option buyer and my friend is an option seller. So here the strike price is 10 lakh. The premium is 1 lakh. In case my friend's son's business is not doing well or doing well but not making more than 10 lakh rupees profit, then he get to keep my 1 lakh with him. So I lose my entire 1 lakh. But in case if he gets more than 10 lakh rupees profit, he has to pass on all the profit to me. So I'll be making more profit. So in this case, I am the option buyer. My friend is option seller. The strike price is 10 lakh. The premium is 1 lakh. This is how the call options work. Nifty will go above this, will not go above this. So this is a game of a call option. Similarly, there are people who feel that Nifty will go below 12,000 or will not go below 12,000. So the people who feel that Nifty will go below 12,000, they will be buying the 12,000 put option. They are known as a buyer of option. And the seller will say it will not go below 12,000, so he will receive the money. As long as Nifty is not going below 12,000, the seller keeps the money, the buyer loses the entire premium paid. In case if Nifty goes below 12,000, how many points it goes below 12,000, that many rupees the seller will have to return to the buyer. Now, the next question. If a buyer of a call option buys for 50 rupees, what will happen tomorrow and day after tomorrow or next few days? Whether the premiums will go up or go down. I'll come back to the cricket analogy. Let us say Virat Kohli starts his first over and many people will not believe that he will hit 100. So the premium will be trading around 10 rupees. But after 1 over, assume that he hits 6 sixes. He has already got 36 runs in 1 over. Then the expectation will shoot up. So expectation will shoot up that Virat Kohli will hit definitely more than 100 runs. So that time the 10 rupees premium may be trading around 20 rupees or 30 rupees. Though Virat Kohli has not hit the century, but the expectation increases when he hits more and more runs now. At the same time, let us say after 3 or 4 overs, Virat Kohli is not performing well. He is just taking only 1 or 2 runs. Then the people will really lose the hope. So that time, the premium of 10 rupees may even come down to 6 rupees or 7 rupees. So the same way in stock market also, if somebody buys a 12,500 call option at 50 rupees and tomorrow if market goes up by 50, 100 points, the expectation will increase. So this 50 rupees may go to 60 rupees, 70 rupees. The buyer can book the profit, can exit. He does not have to wait until the expiry date to make profit. So if you buy a call option, market goes up, you will make some profit. If you buy a put option, market goes down, you will make some money. But again, it is not necessary. Sometime market may go up, still you may lose the money. So that depends on many other factors like volatility and time decay and many other things, which I will explain in my next few videos. For the time being, the simple understanding is that call option buyer will make profit if market goes up, put option buyer will make money if the market goes down, and just opposite for the seller. So hope this video is useful. Continue to watch our channel for more videos. Thank you.